Question 1. Which of the following activities requires a Series 26 principal to approve before implementation? A new marketing campaign for variable annuities to be used with the public. B. A registered representative's request for a vacation. C. The submission of a customer complaint to FINRA. D. A clerical error made by a back-office employee. Answer: A. A new marketing campaign for variable annuities to be used with the public. Explanation: Series 26 principals are responsible for the supervision of investment company and variable contract products, including all communications with the public. A new marketing campaign falls under this purview and requires principal approval to ensure accuracy, compliance with advertising rules, and suitability for the target audience. This oversight protects both the firm and its customers from misleading or non-compliant promotional materials. The practical takeaway is that any public-facing material related to investment company products or variable contracts must be reviewed and approved by a qualified principal. Question 2. A Series 26 principal is reviewing a registered representative's sales activity. Which of the following would raise the most significant red flag regarding potential churning? A. A client's portfolio consists primarily of conservative mutual funds. B. Frequent trades in a customer's variable annuity subaccounts that result in minimal or no investment objective changes. C. A customer consolidating multiple small mutual fund positions into one larger fund. D. A representative assisting a client in establishing an automatic investment plan into a mutual fund. Answer: B. Frequent trades in a customer's variable annuity subaccounts that result in minimal or no investment objective changes. Explanation: Churning involves excessive trading in a customer's account primarily to generate commissions, disregarding the customer's investment objectives. Frequent trades in variable annuity subaccounts, especially when they do not align with a clear change in investment objective or offer significant benefits, strongly suggest churning due to the potential for excessive fees and charges impacting the customer's returns. A Series 26 principal must monitor for such patterns as part of their supervisory responsibilities. The practical takeaway is that principals must be vigilant for trading patterns that benefit the representative more than the client, especially when frequent and unnecessary. Question 3. Under FINRA rules, how often must a member firm's supervisory system be tested and verified by an independent review? A. Annually. B. Every 2 years. C. Every 3 years. D. Upon notice from FINRA. Answer: A. Annually. Explanation: FINRA Rule 3120 requires that a member firm's supervisory control system be tested and verified annually. This independent review ensures that the firm's supervisory procedures are effective and compliant with all applicable rules and regulations. The designated principal, often a Series 26 principal for relevant areas, is responsible for implementing and documenting this annual review. The practical takeaway is that ongoing, documented annual reviews are a critical component of maintaining a robust and compliant supervisory system within a firm. Question 4. Which of the following is not typically a responsibility of a Series 26 principal regarding variable annuity sales? Approving all variable annuity applications before submission to the insurance company. B. Ensuring that representatives complete ongoing product-specific training. C. Managing the investment portfolio of the separate account for variable annuities. D. Reviewing customer communications related to variable annuities. Answer: C. Managing the investment portfolio of the separate account for variable annuities. Explanation: A Series 26 principal's responsibilities primarily involve the supervision of sales practices, representatives, and communications pertaining to investment company products and variable contracts. While they oversee the sales process and suitability, they do not manage the underlying investment portfolio of the separate account, that is typically handled by investment managers hired by the insurance company. The principal's role is supervisory, ensuring compliance and proper conduct, not direct fund management. The practical takeaway is to differentiate between supervisory responsibilities, Series 26, and investment management responsibilities, typically Series 65-66 or other portfolio managers. Question 5. A registered representative leaves a member firm. Which form must the firm file to notify FINRA of the termination? A. Form U4. B. Form U5. C. Form BD. D. Form BR. Answer B. Form U5. Explanation. When a registered representative terminates their association with a member firm, the firm must file Form U5, Uniform Termination Notice for Securities Industry Registration, with FINRA. This form notifies regulators of the termination, including the reason for termination, and must be filed within 30 days. Form U4 is used for initial registration, Form BD for broker-dealer registration, and Form BR for branch office registration. The practical takeaway is that Form U5 is crucial for maintaining accurate and timely registration records with FINRA upon an individual's departure. Question 6. Which of the following statements about a selling away violation is most accurate? A. It occurs when a representative sells securities not offered by their employing broker-dealer without prior written approval. B. It refers to a representative making cold calls to clients located in another state. C. It describes a situation where a representative exclusively sells proprietary products of their firm. D. It is a violation only if the customer loses money on the investment. Answer. A. It occurs when a representative sells securities not offered by their employing broker-dealer without prior written approval. Explanation. Selling away, also known as private securities transactions by FINRA, occurs when a registered representative sells securities to a customer without their employing broker-dealer's knowledge and written approval. This is a serious violation because the firm cannot supervise these transactions, exposing both the firm and customers to significant risks. The violation stands regardless of whether the customer experiences a profit or loss. The practical takeaway is that representatives must always obtain written firm approval before engaging in any securities transactions outside the scope of their employment. Question 7. A Series 26 principle is establishing procedures for reviewing customer complaints. Which of the following is a mandatory requirement under FINRA rules? A. All written customer complaints must be forwarded to FINRA within 1 business day. B. All complaints must be maintained in a separate complaint file at the branch office for at least 3 years. C. The firm must provide an immediate monetary settlement to any customer filing a written complaint. D. A principal must promptly review and take action on all written customer complaints. Answer. D. A principal must promptly review and take action on all written customer complaints. Explanation. FINRA Rule 4513 requires that all written customer complaints be promptly reviewed by a principal. The principal must investigate the complaint and take appropriate action to resolve it, which could include further investigation, disciplinary action against a representative, or customer redress. While firms have reporting obligations for certain types of complaints, not all written complaints are immediately forwarded to FINRA. The practical takeaway is that a principal's prompt and thorough review of written complaints is crucial for customer protection and regulatory compliance. Question 8. Which of the following is a primary objective of the Securities Act of 1933? A. To regulate the secondary market for securities. B. To ensure full and fair disclosure in the primary market. C. To establish the Securities and Exchange Commission, SEC. D. To prohibit insider trading. Answer B. To ensure full and fair disclosure in the primary market. Explanation. The Securities Act of 1933, often referred to as the Truth in Securities Law, aims to ensure that investors receive adequate information about new securities offerings in the primary market. It mandates full and fair disclosure through the registration statement and prospectus, allowing investors to make informed investment decisions. This act primarily governs the issuance of new securities, while subsequent legislation like the Securities Exchange Act of 1934 focuses on the secondary market. The practical takeaway is that the 33 Act is foundational for investor protection and initial public offerings and other primary market distributions. Question 9. When must a Series 26 principal approve an order ticket for a mutual fund purchase? A. Before the order is placed. B. Before the trade is executed. C. Promptly after execution, typically by the end of the trading day. D. Only if the order exceeds a certain dollar amount. Answer. C. Promptly after execution, typically by the end of the trading day. Explanation. For most types of securities transactions including mutual fund purchases, a principal's approval is required promptly after execution, typically by the end of the trading day. While suitability must be determined prior to recommending a transaction, the actual order ticket often gets approved post-execution but on the same day. This ensures that the principal can review the transaction for compliance, suitability, and accuracy. The practical takeaway is that timely principal review of order tickets is essential for proper supervision and compliance, even if it occurs after the trade is placed. Question 10. A mutual fund's expense ratio is calculated by dividing A. Total expenses by the fund's total assets. B. Management fees by the fund's net asset value, NAV. C. Sales charges by the total amount invested. D. 12b-1 fees by the number of shares outstanding. Answer: A. Total expenses by the fund's total assets. Explanation: the expense ratio of a mutual fund represents the total annual operating expenses as a percentage of the fund's average net assets. It includes management fees, administrative costs, and 12b-1 fees, among others. A lower expense ratio generally means more of the fund's returns go to investors, making it a critical factor for investors to consider. The practical takeaway is that the expense ratio is a key indicator of the ongoing cost of owning a mutual fund and directly impacts an investor's net returns. Question 11. What is the primary purpose of a separate account in a variable annuity? A. To hold the insurance company's general assets. B. To offer investment options that fluctuate with market performance. C. To provide a guaranteed minimum interest rate. D. To fund the fixed annuity component of a hybrid product. Answer: B. To offer investment options that fluctuate with market performance. Explanation: the separate account in a variable annuity is segregated from the insurance company's general assets and is where the investor's premiums are allocated to various investment options, sub-accounts, such as stock or bond portfolios. The value of these sub-accounts, and therefore the annuity's cash value and death benefit, fluctuates with the performance of the chosen investments. This contrasts with a fixed annuity, where the insurer guarantees a principal and minimum interest rate. The practical takeaway is that the separate account introduces market risk and growth potential to a variable annuity, distinguishing it from fixed insurance products. Question 12. Which of the following is considered a red flag for potential money laundering activity that a Series 26 principal should identify? A. A customer makes a large cash deposit and immediately requests a wire transfer to an unrelated third party. B. A customer routinely makes electronic transfers from their bank account to their investment account. C. A customer deposits a check from a known and reputable source. D. A customer's investment account shows consistent growth over several years. Answer: A. A customer makes a large cash deposit and immediately requests a wire transfer to an unrelated third party. Explanation: a customer making a large, unusual cash deposit followed by an immediate request for a wire transfer to an unrelated third party is a classic red flag for money laundering. This pattern suggests an attempt to layer illicit funds by moving them quickly through the financial system to obscure their origin. Series 26 principals have a responsibility under the Bank Secrecy Act and firm AML programs to identify and report such suspicious activities. The practical takeaway is to be alert for transactions that lack clear economic purpose or deviate significantly from a customer's normal behavior. Question 13. FINRA Rule 2210 governs communications with the public. A Series 26 principal is responsible for reviewing and approving which of the following? A. Internal memos to firm employees regarding holiday schedules. B. A pre-approved form letter sent to all new clients welcoming them to the firm. C. An email from one registered representative to another regarding a shared client. D. Personal correspondence between a representative and a family member. Answer: B. A pre-approved form letter sent to all new clients welcoming them to the firm. Explanation: FINRA Rule 2210 requires principals to review and approve all retail communications and correspondence with the public. A pre-approved form letter sent to new clients welcoming them to the firm falls under the definition of retail communication or correspondence, depending on the number of recipients, and must therefore be reviewed and approved by a principal. This ensures that all public communications are fair, balanced, and not misleading. The practical takeaway is that principals must exercise strict oversight over all materials used by representatives to communicate with clients or prospective clients. Question 14. Under FINRA's Code of Procedure, how long does a respondent typically have to file a written answer to a complaint after receiving it? 10 days. B. 25 days. C. 30 days. D. 45 days. Answer B. 25 days. Explanation. Under FINRA's Code of Procedure, a respondent typically has 25 days to file a written answer to a complaint after receiving it. This timeframe allows the respondent to review the allegations and prepare an appropriate response. Failure to respond within the stipulated period can lead to default proceedings. The practical takeaway is that strict adherence to FINRA's procedural timelines is critical for any individual or firm involved in a regulatory action. Question 15. What is the primary role of a designated Series 26 principal in a member firm? A. To execute trades on behalf of retail clients. B. To manage the firm's overall financial records. C. To supervise the activities of registered representatives engaging in investment company and variable contract business. D. To develop new investment products for the firm. Answer. C. To supervise the activities of registered representatives engaging in investment company and variable contract business. Explanation. A Series 26 principal's primary role is to supervise the activities of registered representatives involved in the solicitation, purchase, and/or sale of investment company products and variable contracts. This includes ensuring compliance with securities rules, reviewing sales practices, and overseeing communications. Their focus is on ensuring proper conduct and adherence to regulatory requirements within their scope of authority. The practical takeaway is that the Series 26 principal is a critical gatekeeper for compliance and ethical conduct in the variable products and investment company business lines. Question 16. Which of the following would not be included in a mutual fund's prospectus? A. The fund's investment objectives and policies. B. The names of the fund's portfolio managers. C. Detailed projections of future returns over the next 5 years. D. The fund's sales charges and expense ratio. Answer. C. Detailed projections of future returns over the next 5 years. Explanation. A mutual fund prospectus is a legal document that provides essential information to potential investors, including investment objectives, risks, fees, and past performance. However, prospectuses are prohibited from including detailed projections of future returns. Regulators consider such projections speculative and potentially misleading, as past performance does not guarantee future results. The practical takeaway is that investors should be wary of any investment literature that guarantees or projects specific future returns, as this is typically prohibited in regulated disclosures. Question 17. Regarding continuing education (CE) requirements for registered persons, a Series 26 principal must ensure representatives complete which two components? A. Firm element and regulatory element. B. Product element and supervisory element. C. Initial training and annual review. D. Ethical conduct and compliance training. Answer. A. Firm element and regulatory element. Explanation. FINRA's continuing education (CE) requirements consist of two main components, the regulatory element and the firm element. The regulatory element is administered by FINRA and focuses on regulatory changes, while the firm element is developed and delivered by the firm to its registered employees, focusing on relevant products, services, and regulatory requirements. A Series 26 principal is responsible for overseeing that representatives under their supervision complete both components within the required timeframes. The practical takeaway is that ongoing education through both regulatory and firm-specific training is vital for maintaining competence and compliance in the securities industry. Question 18. An agent is recommending a variable annuity to a client. Which of the following is paramount for the Series 26 principal to consider during the suitability review? A. The client's current age and retirement timeline. B. The agent's commission generated from the sale. C. The marketing materials provided by the annuity issuer. D. The client's preference for a specific sub-account manager. Answer. A. The client's current age and retirement timeline. Explanation. When reviewing a variable annuity recommendation, the client's current age and retirement timeline are paramount for the Series 26 principle to consider for suitability. Variable annuities are long-term investment vehicles often used for retirement planning, and their complex features, surrender charges, and potential tax implications make them unsuitable for short-term goals or very elderly clients who may not live long enough to benefit. The principle must ensure the product aligns with the client's financial situation, investment objectives, and time horizon. The practical takeaway is that the long-term nature and associated costs of variable annuities necessitate a thorough suitability analysis, especially concerning the client's age and investment horizon. Question 19. Which of the following is true regarding a statutory disqualification? A. It prohibits an individual from associating with a FINRA member firm in any capacity. B. It can only occur if an individual is convicted of a felony involving securities within the last 5 years. C. It requires a firm to immediately terminate an individual's registration, but the individual can still work in an unregistered capacity. D. It only applies to individuals involved in investment banking activities. Answer. A. It prohibits an individual from associating with a FINRA member firm in any capacity. Explanation. A statutory disqualification is a serious regulatory consequence that prohibits an individual from associating with a FINRA member firm in any capacity unless FINRA grants a waiver. It typically results from certain felony convictions, certain misdemeanor convictions related to securities, or violations of securities laws within the past 10 years, not 5. If an individual is statutorily disqualified, they cannot work for a member firm even in an unregistered capacity without FINRA's express approval. The practical takeaway is that statutory disqualification is a severe impediment to working in the securities industry, underscoring the importance of ethical and lawful conduct. Question 20. A Series 26 principal is conducting an annual review of a branch office. Which of the following is a mandatory component of this review? A. A surprise audit of all customer accounts for suspicious activity. B. A physical inspection of the branch office location. C. A detailed analysis of the branch's profitability for the past year. D. A mandatory meeting with every customer of the branch. Answer. B. A physical inspection of the branch office location. Explanation. FINRA rules require that each Office of Supervisory Jurisdiction (OSJ) and any branch office that supervises one or more branch offices be inspected annually. All other branch offices must be inspected at least every 3 years. A physical inspection ensures that the office is operating in compliance with firm policies and regulatory requirements. The practical takeaway is that regular physical inspections are a crucial part of a principal's supervisory duties to ensure operational integrity and compliance at all firm locations. Question 21. Under FINRA rules, all new account applications for investment company products and variable contracts must be approved by a principal. When must this approval occur? A. Before the account is opened. B. Within 1 business day of the account being opened. C. Within 3 business days of the account being opened. D. Within 7 business days of the initial transaction. Answer. B. Within 1 business day of the account being opened. Explanation. FINRA Rule 2090 Know Your Customer, and Rule 4512 Customer Account Information, require that a principal must approve all new customer accounts promptly after the initial transaction, but no later than within 1 business day. This approval ensures that all required information has been obtained, that the account is suitable for the client, and that the firm's policies and procedures have been followed. The practical takeaway is that prompt principal approval of new accounts is a critical step in maintaining regulatory compliance and customer protection. Question 22. Which of the following actions by a registered representative would most likely lead to a formal disciplinary action by FINRA? A. Failing to renew a state securities license on time due to an administrative oversight. B. Accepting an unsolicited gift from a client valued at $150. C. Sharing confidential client information with an unauthorized third party. D. Making an inadvertent error when calculating a client's portfolio performance. Answer. C. Sharing confidential client information with an unauthorized third party. Explanation. Sharing confidential client information with an unauthorized third party is a serious breach of privacy and ethical conduct, violating FINRA's Rule 2090, Know Your Customer, and potentially other privacy regulations. This would most likely lead to severe disciplinary action due to the potential harm to clients and the integrity of the financial system. Accepting a gift valued at $150 is typically within FINRA's de minimis gift rule, $100 per person per year, while administrative errors or license renewal oversights, though issues, are generally less severe than privacy breaches. The practical takeaway is that protecting client confidentiality is a paramount ethical and regulatory obligation for all registered persons. Question 23. What is the primary difference between a front-end load and a back-end load in a mutual fund? A front-end load is a sales charge paid at the time of purchase, while a back-end load is paid upon redemption. B. A front-end load is assessed annually, while a back-end load is a one-time charge. C. A front-end load applies to institutional investors, while a back-end load applies to retail investors. D. A front-end load is tax-deductible while a back-end load is not. Answer: A. A front-end load is a sales charge paid at the time of purchase, while a back-end load is paid upon redemption. Explanation: a front-end load, Class A shares, is a sales charge deducted from the initial investment amount at the time of purchase, meaning less money is immediately invested. A back-end load, also known as a contingent deferred sales charge (CDSC), found in Class B shares, is a sales charge paid by the investor when shares are redeemed, typically decreasing over time the longer the investor holds the shares. Both are forms of sales charges that compensate the broker-dealer for selling the fund. The practical takeaway is that investors must understand how these loads impact their total return and choose the share class that aligns with their investment horizon. Question 24. When recommending a variable life insurance policy, a Series 26 principle must ensure that the registered representative has explained which of the following to the customer: the guaranteed cash value growth of the policy. B. The fact that death benefits will never decrease below the initial face amount. C. The policy's investment risks and potential for loss of principal. D. The fixed interest rate applied to the policy's cash value. Answer: C. The policy's investment risks and potential for loss of principal. Explanation: variable life insurance policies offer investment options that fluctuate with market performance, meaning they carry investment risks, and the policy's cash value and even the death benefit, beyond a minimum guarantee, can decrease. A Series 26 principle must ensure that representatives clearly explain these investment risks and the potential for loss of principal to the customer. Misrepresenting guarantees or fixed returns would be a serious suitability violation. The practical takeaway is that transparency regarding market risks is paramount when selling variable products, as they are not guaranteed investment vehicles. Question 25. Under FINRA Rule 3110, a firm's written supervisory procedures, WSPs, must be: A. Filed with FINRA for approval prior to implementation. B. Tailored to the firm's business and provide for the supervision of associated persons. C. Reviewed and updated only when FINRA issues new rules. D. Made available to the public upon request. Answer: B. Tailored to the firm's business and provide for the supervision of associated persons. Explanation: FINRA Rule 3110 requires member firms to establish and maintain a system to supervise the activities of each associated person, which includes creating and maintaining written supervisory procedures, WSPs. These WSPs must be tailored to the firm's specific business lines and reasonably designed to ensure compliance with securities laws and FINRA rules. WSPs are not typically filed with FINRA for approval, but rather are subject to examination by regulators. The practical takeaway is that effective WSPs are the cornerstone of a firm's supervisory system, requiring ongoing customization and adherence. Question 26. A registered representative is registered with one member firm and wishes to engage in an outside business activity for compensation. What action must the representative take? A. Obtain approval from FINRA before engaging in the activity. B. Provide prior written notice to their employing member firm. C. Disclose the activity only if it involves securities. D. Only notify the firm if the activity generates significant income. Answer: B. provide prior written notice to their employing member firm. Explanation: FINRA Rule 3270 requires that registered representatives provide prior written notice to their employing member firm before engaging in any outside business activity for compensation. This allows the firm to assess if the activity presents any conflicts of interest, interferes with the representative's responsibilities, or requires additional supervision. The firm must then determine if it allows the activity and if additional conditions apply. The practical takeaway is that transparency with the employing firm about outside business activities is crucial for compliance and avoiding conflicts of interest. Question 27. Which of the following is an example of an investment company product that generally offers investors professional management and diversification through a portfolio of securities? A treasury bond. B. A direct participation program (DPP). C. An exchange-traded fund (ETF). D. A variable annuity. Answer: C. An exchange-traded fund (ETF). Explanation: An exchange-traded fund (ETF) is a type of investment company that typically holds a portfolio of stocks, bonds, or other assets, and its shares trade on stock exchanges like individual stocks. ETFs offer professional management, usually passive, tracking an index, and diversification similar to mutual funds, but with the added flexibility of intraday trading. Treasury bonds are debt instruments, DPPs are typically illiquid investments, and variable annuities are insurance products with underlying investment subaccounts. The practical takeaway is that ETFs provide an accessible and diversified way for investors to gain exposure to various markets or asset classes. Question 28. A Series 26 principle must ensure that all advertisements for investment company products comply with FINRA standards for fair and balanced presentations. This means advertisements must emphasize only the positive aspects of the investment. B. Include past performance data without any disclaimers. C. Present both the potential benefits and risks of the investment. D. Be approved by the SEC before public use. Answer: C. Present both the potential benefits and risks of the investment. Explanation: FINRA Rule 2210 requires that all communications with the public, including advertisements, be fair and balanced. This means they must present both the potential benefits and risks of an investment product, avoid exaggerated claims, and not omit material information. Simply emphasizing positive aspects or omitting disclaimers on performance data would violate this rule. The practical takeaway is that a principal's review of advertising must prioritize transparency and ensure that investors receive a complete and unbiased view of an investment. Question 29. Under FINRA rules, what is the maximum permissible sales charge for an open-end mutual fund? A. 5% of the public offering price. B. 8.5% of the public offering price. C. 10% of the net asset value. D. There is no maximum as long as it's disclosed. Answer: B. 8.5% of the public offering price. Explanation: FINRA Rule 2341, Investment Company Securities, generally limits the maximum sales charge on open-end mutual funds to 8.5% of the public offering price. This maximum applies to funds that do not offer breakpoints or rights of accumulation. If a fund offers these features, the maximum sales charge is often lower. This rule is designed to protect investors from excessive sales loads. The practical takeaway is that principals must ensure representatives do not sell funds with excessive sales charges, especially when breakpoint opportunities are available. Question 30. A Series 26 principal discovers that a registered representative has been accepting free meals and entertainment from an investment company wholesaler beyond the firm's approved limits. This situation most directly violates the firm's policies regarding A. Outside business activities. B. Gifts and gratuities. C. Suitability standards. D. Continuing education requirements. Answer: B. Gifts and gratuities. Explanation: This scenario most directly violates the firm's policies regarding gifts and gratuities, which are typically based on FINRA Rule 3220. This rule generally limits gifts and gratuities to $100 per person per year, with exceptions for reasonable business entertainment that is not excessive or frequent. Exceeding these limits can create perceived or actual conflicts of interest and influence recommendations. The practical takeaway is that firms must have clear policies on gifts and entertainment, and principals must rigorously enforce them to maintain ethical conduct and avoid conflicts of interest. Question 31. When a customer wishes to roll over funds from a 401k into a variable annuity, what specific disclosure must a Series 26 principal ensure the representative makes? A. The variable annuity provides superior investment returns compared to the 401k. B. The variable annuity offers a guaranteed income stream regardless of market performance. C. The customer will lose access to all tax-deferred growth in the variable annuity. D. The tax-deferred growth is already available in the 401k and is not a new benefit for the variable annuity. Answer: D. The tax-deferred growth is already available in the 401k and is not a new benefit for the variable annuity. Explanation: when recommending a rollover from a tax-qualified plan like a 401k to a variable annuity, a Series 26 principal must ensure the representative discloses that tax-deferred growth is already a feature of the 401k. Therefore, the tax-deferred growth offered by the variable annuity is not a new benefit, and the customer would be paying additional fees for features they already possess. This disclosure is crucial for proper suitability and avoiding misleading clients. The practical takeaway is that representatives must clearly articulate the benefits and costs of such rollovers, highlighting which features are truly new versus those already existing in the original plan. Question 32. Which of the following describes the breakpoint feature of mutual funds? A. A reduction in the sales charge for larger purchases of fund shares. B. A point at which the fund's NAV reaches a new all-time high. C. A penalty for redeeming fund shares before a certain period. D. A mechanism to automatically reinvest dividends at NAV. Answer: A. A reduction in the sales charge for larger purchases of fund shares. Explanation: a breakpoint in mutual funds refers to a schedule of reduced sales charges, loads, that are applied to larger purchases of fund shares. As an investor's cumulative investment reaches certain predetermined dollar amounts, the sales charge percentage decreases. Series 26 principals must ensure representatives are aware of and inform clients about breakpoint opportunities, as failing to do so, a breakpoint sale, can be a suitability violation. The practical takeaway is that principals must train representatives to identify and offer breakpoint advantages to eligible customers, optimizing their investment and minimizing costs. Question 33. A Series 26 principal discovers that a registered representative has been using personal text messages to communicate with clients about investment recommendations. What is the firm's immediate primary concern? A. The representative might be over-communicating with clients. B. The text messages are not being properly supervised and archived. C. The client may not understand the informal language used. D. The representative is using their personal device for business. Answer: B. The text messages are not being properly supervised and archived. Explanation: the immediate primary concern is that the text messages are not being properly supervised and archived. FINRA Rule 2210 requires that all communications with the public related to the firm's business be supervised and retained. If personal text messages are used for recommendations, the firm loses its ability to oversee these communications, risking compliance violations and potential liability. The practical takeaway is that firms must implement robust policies and technologies to capture and supervise all business-related electronic communications, regardless of the platform used. Question 34. Which regulatory body primarily sets rules for the sale and distribution of mutual funds and variable annuities? The Federal Reserve Board. B. The Municipal Securities Rulemaking Board, MSRB. C. The Financial Industry Regulatory Authority, FINRA. D. The Commodity Futures Trading Commission, CFTC. Answer: C. The Financial Industry Regulatory Authority, FINRA. Explanation: the Financial Industry Regulatory Authority, FINRA, is the primary self-regulatory organization, SRO, that oversees broker-dealers and their registered representatives in the U.S. This includes setting rules for the sale and distribution of mutual funds and variable annuities, as these are securities products. While the SEC has ultimate oversight, FINRA's rules, e.g., suitability, communications, supervision, directly govern the day-to-day practices of firms and individuals in this area. The practical takeaway is that FINRA is the frontline regulator for broker-dealer conduct in the investment company and variable contract space. Question 35. A Series 26 principle is reviewing a branch office's procedures for handling customer funds and securities. Which of the following practices would be explicitly prohibited? A. Accepting a check from a client made payable directly to the firm. B. Allowing a registered representative to hold customer mail for convenience. C. Maintaining a log of all incoming client checks. D. Forwarding customer checks to the firm's operations department for processing. Answer: B. Allowing a registered representative to hold customer mail for convenience. Explanation: allowing a registered representative to hold customer mail for convenience is explicitly prohibited and considered a holding mail violation. This practice creates significant risks, including potential misdirection of important account statements, trade confirmations or checks, and could facilitate fraudulent activity by the representative. Firms must have procedures to ensure customer mail is delivered directly to the customer's address of record, unless specific, temporary, and documented instructions are provided under limited circumstances. The practical takeaway is that firms must have strict controls over client communications and assets to prevent unauthorized access or manipulation by representatives.